Hello and welcome to the Harwood Report for June 11, 2018, presented by Trade Academy. I am Keith Harwood, the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read the rest of these disclosures. I want to talk a little bit about really focusing on what's going on in equities, bonds, gold. And oil is important. This week we've got a lot of stuff going on. So over the weekend we had the G7. It sounded like things were a little bit rocky there. The meeting with Trump and Kim Jong-un is basically in the next 24 hours, and it sounds like things are going relatively smoothly there. And we've got the Fed decision on Wednesday. So there's a lot of macro stuff coming out that can really move the markets here, up or down. Trade negotiations haven't necessarily gone swimmingly, but the market's shrugging it off. I think there's an expectation that it's all going to be fine. You can have disagreements with your friends and still work it out. But at the end of the day, we want to make sure that they remain friends. So let's see how that progresses. You can see the greed is up to 66 on the fear and greed metric, and the one that's lagging is still market momentum. So if the market's going to be showing this kind of greed level, I think I need to see new highs in the S&P, and that's going to be the tell that maybe we get to an overbought frothy condition that can be just faded for a short term. You can see in SPY that we're pressing near the March highs, but we're not yet to the January highs, which are about $5.50, $6 away. But if I look at some others, IWM is the most extreme, way over the January highs, about $5 over. So we're talking about 3% above. Actually closer to $6 over. And Qs are about 3% above as well. Trading, the January high was around 171, and we're right now at 175, so $4, 2 to 3% higher. What's dragging is the industrials. So you can see that Dow Jones Industrial Average looks a little bit more like the Qs in terms of the chart. Looks a little more like SPY in terms of the chart. It's basically holding back the market a little bit from making these major new highs for the S&P 500. But we are seeing some greed coming into small caps and tech. So how do I play for that catch up in SPY? So I'm looking for, in the near term, a pop through this 280 and 280-ish level to 280.41, and probably press towards 285. May take a couple weeks. The way that I'm kind of thinking about playing this right now is because the June 15th vol is bid because of the events of this week, and the June 22nd vol is offered because it doesn't have those events, is to just do a very simple diagonal. So what I've put here is buying a slightly out of the money June 22nd call, the 281s, selling this June 15th 282.5 call, paying about 52 cents. That gives me some good leverage to the upside. If the market breaks out, I do really well. You can see that I'm not paying any theta. I've got a little bit of gamma, a little bit of delta. It's a good R&R trade overall. And if the market blows up the upside, this goes to $1.50, and I still triple my money. So doing this for 50, we'll call it 51 cents, seems like a reasonable structural trade in the market. Trading again with the S&P 500 having lagged a little bit, and looking for it to play some catch up relative to small caps. I go to TLT, and it's a little tough here because we've got the Fed meeting this week. Vol's a little bit bid. The at-the-money straddle is about $1.30 for this week. That's probably pretty fair. I think the play here is to wait till after the Fed meeting to make a decision on what's next. So it's kind of one of those spots where it's a wait-and-see game as opposed to an aggressive positioning game. Where there may be more opportunity here is in gold. And we can see the dollar-yen's firm. Bounced off the 10-day moving average very well there on from Friday's drop. Seems like this is wanting to play the breakout to the upside. And let's look at the dollar as well. That seems like it's bottoming here. It's decent action. Both of those impacts should be bearish gold. And yet gold is just kind of sitting a little bit firm. Seems like maybe the market's trying to use gold as a hedge for the macro risk. But if that's a problem, then maybe they should have been going into bonds, because I don't see the Fed raising rates quickly if there's a problem there. So here's the play for me. Very simple. GLD, let's look at that chart again. If we have a bearish Fed, plus things go well with Kim Jong-un, that's two negative impacts to gold. We don't need the hedge for the North Korea risk, and we don't need to see a gold buyer if there's potential for greater interest rate hikes, because that's going to help stop inflation, slow inflation. This week the vol's bid a little bit. But I can do these 122 puts for 18, 19 cents. Call it 19 cents, paying the offer. So where's 19 cents on this chart? Where's the 122? Well, that low is 122. So if this creates that kind of bearish input where gold breaks down to a new low, see it pricing down towards 120. It's huge R&R when the inputs should come this week. So just to give you a comparison, if I go to next week, the 122 puts are 35 cents. Still cheap, but the leverage is much greater this week if the event occurs. If it doesn't occur, these should drop down below 19 cents because that vol bid shouldn't be there. So even if the market just sits for a week and I come in next week, these June 122 puts, they would drop to probably, it would be the equivalent of looking at these at not a 16 vol. I apologize for that, a 9 vol. And that would put them at 11 cents. So why would I pay 16 cents more for a week with my real risk being that the market just drops 75 cents, then next week's puts would have been a better play. Otherwise, I think this week's puts are the only play. So what I'm looking at this week is the June 122 puts for 19 cents. If this market is correct, if the market continues to firm, if TLT stays weak, if the dollar continues to bounce, gold's got to get bearish. So I'm looking at the June 15th 122 puts. I think that's a really interesting R&R, and it can be an explosive payout, so I don't have to put that much money in it to make my payoff. And I don't want to put that much money in it, to be fair, because if I do, when I don't actually know what the Fed's going to do, that's irresponsible of me. I want to do this because the R&R is there on a 50-50 kind of move. I think that a bearish gold move is at least a 50% probability, but the magnitude of that move is potentially huge. That's where my R&R comes from, not from knowing that it's going to be particularly bearish. SLV, it should be weak too, and look at that, it's kind of breaking out to the upside. So if things change, this could actually catch some people off guard and press above 16.5. That said, seems like there's been some money into silver, and that may be the one that collapses even more. Could go below 15. This could be the trigger to say, well, once again, silver at the highs, it's time to press it back down to lows, below 15.20, down to 15.10 again, and maybe even the final washout. Or the bigger washout. Let's just see how that plays out. I'll talk more about how I'm going to look to play silver in the premium product that I'll talk about after I'm done with this conversation. And the miners, I think, are just another one to just watch. They haven't been moving as much, but the volatility is very cheap in the miners. And if gold does wash out, maybe there can be an explosive move lower in these guys as well. Finally, I want to go to oil. So oil maybe finally found a bottom. It had a big pullback last week and the week before as OPEC started talking about increasing production, and bam, now we finally seem to have found the buyers. It really happened here right around that 100-day moving average, so the washout blew through the 10 and the 20-day really quickly, didn't stop for long at the 50, and then just kind of kept going. Now it seems like it's finding a floor. It's back above the 10-day moving average after finding a bottom at the 100-day moving average, so maybe we're seeing some rotation back out here. In that sense, that's going to actually create should create some bullish potential for XLE. Taking new high there, above 79. And OIH. This one's gotten hit a little bit harder. That one makes that one the more explosive move. So OIH is where I want to focus my trade. USO firms, OIH has a lot more upside. XLE is already showing you that maybe there should be some firmness in this sector. If I look at the vol in OIH, because we know vol on the whole is getting hit a lot. VIX is cheap. If I go to OIH though, and look at the vol levels, it basically doesn't get below 26%. And right now it's at 27.5. There's some explosive upside here. This is 4th of July week, so there's a trading day missing. Why don't I just go to July? 29 calls for 27 cents. The risk here is that we don't make the new all-time high. Because 29 calls for 27 cents are playing basically for a move to a new all-time high. Frankly, that's still a triple if we just test the highs. There's a lot more money there if we make a new all-time high. So I think that's kind of the play. Sub 26 vol in an ETF that has explosive upside. And it doesn't have to happen this week. If it takes oil a week to drag up all these oil companies again, that's okay for this trade. If it takes it a month, that's okay for this trade. So I get a lot of time with cheap vol, cheap gamma, and an explosive potential move. I don't see a lot wrong with that idea. It's just that easy, guys. So I'm thinking that the S&Ps are going to play a little bit of catch up. Qs and IWM actually could have some big movement this week. And that brings me to the Harwood Report. I'll talk more about what I'm thinking with the Qs and IWM, as well as more of the SLV miners trade, XLE trade, all that sort of stuff in the newsletter that I'll be posting shortly. I also do a midweek update. First 2 weeks are free. That's $0. No cost whatsoever. If you like it after that, it's 49 bucks a month. It's still pretty cheap. Take a look, see what you think. If it adds value to your trading, $49 per month isn't that big of a cost. And if it doesn't add value to your trading, it didn't cost you anything because you got 2 weeks for free. All right, folks, go to tradeacademy.co/Harwood Report to check it out and sign up. Email me, Keith@tradeacademy.co, no M, or call me 312-600-8004 with comments or questions. Have a great trading day, folks. Talk soon.